What's up, guys? Eric here, Mr. Fired Up Wealth. Excited today to bring you a top 5 dividend growth investing stocks for the month of July 2021. Now, these are going to be focused on dividend growth investing for F.I.R.E.D. I call it DGIF. So that means total appreciation, total growth. You think of the stock price appreciation plus the dividend growing. And that's kind of the focus overall. So these are going to be lower dividends with higher upside, I think, for overall appreciation of the stock price. So I'm going to look at 5 stocks. And in fact, if you're patient, maybe there'll be even a bonus pick or 2. So you'll definitely want to stay tuned for the entire video. There's a couple stocks in here that you might not know about, or you might not have seen coverage from Fired Up Wealth before. There's a couple stocks in here that I own in the portfolio, and there's several stocks in here that I do not own in the portfolio that I may or may not be interested in buying for the month of July. So you're going to want to watch this video in its entire duration. It's filled full of nuggets. Stay tuned. All right, guys, so it's July and we're at all-time highs on the major indexes, and you say, well, I want to put some money to work. Now, of course, you can always hold some cash and you can wait for an opportunity because opportunities generally do strike. But why not look at some stocks that might be a good opportunity even at the levels now, even though the indexes are at all-time highs? So we're going to look at 5 stocks today, and the first one is Logitech. Now, Logitech only trades at a 22.42 PE ratio. It pays a 0.71% dividend yield. So these are going to be generally lower dividend type stocks that have growth in the dividend, but also have growth in the share price. So we're talking about dividend growth investing for F.I.R.E.D is what I call it, or DGIF. These are going to be more growth stocks that pay a little dividend. They're not like income stocks like a AT&T or Verizon. So Logitech, though, honestly, it's made a nice pullback. 52-week range, the high was $140. It's come back nicely. It's down again today about 1.83%. I think it could go maybe a little bit lower, but even in this range, $120, I think it's a decent opportunity with some upside. You're not overpaying. So if you're a long-term investor, you're paying 22 PE ratio for this company, I think you could feel pretty good about it. I'm going to show you some more information from a most recent presentation that they did for investors. And this really paints a good picture about the business. So we enable people to pursue their passions and connect to the world. Now, a lot of people look at this as kind of a COVID play, right? So they think, well, there's no reason to buy a Logitech because it's only benefited from the pandemic. Well, this is actually going to help explain that that might not be the case. So growing behind secular trends. So, work from anywhere, work from home, remote work, hybrid type work. This trend is a big deal, and it's going to continue to be a secular growth trend. The camera you're looking at right now, this is a Logitech 4K camera. So I generally like to own stocks that, of companies that I use, their products. And it's funny because I've used Logitech products forever. I've actually done videos on Logitech. It was one of my top picks during the pandemic as a pandemic stock. Never bought it. And now I look at it, like, hey, I did well with all these growth names. Let's go to more of a value type name and put some money to work there when, CrowdStrike and all the big hyper growth stocks are at crazy all-time highs. You don't want to pay, you don't want to overpay in FOMO. You don't want to chase these growth stocks. So let's find some value type stocks that are trading at reasonable valuations. And this is definitely going to fit the bill. Work spreads from the office to everywhere. Video calls replace audio calls, gaming moves. So gaming's a big thing. It's going to continue to be a trend. This is what I wanted to show you guys. Logitech has outperformed prior to COVID-19. So they were outperforming before. So this is interesting too, because the white line is the NASDAQ, S&P is the orange, and then you got this purple line, that's Logitech. So it's saying that it doubled every 2.5 years from January of 2013 to January 2020. So this was already a great stock before the pandemic, and it's continuing to be a good stock, after the pandemic as well. So it continued to outperform since COVID-19. So $11 billion in market cap increase, and you could argue it should be even higher than that. You can see the purple line is Logitech, NASDAQ down here, S&P down here. This is a winner. It's one that I should already own, and I'm looking to add it to my portfolio in July. Up next, my friend Charlene. Well, she loves John Deere Green, and I just did a deep dive video on the channel. It's about 30 minutes, so if you're interested in more information about John Deere, check out the video on the channel. There's a link above. Make sure to subscribe to the channel, hit the like button, and drop a comment. But John Deere is one that I do actually own, but I only have about 20 shares. In Discord, it was one of my picks. I had 3 picks that I was focused on in June. So if you're interested in joining Discord, I do this every month. And for June, John Deere was one that I targeted. And I said to the Discord community, I thought the stock would come down to about $325. I called it before it actually broke down. It looked like the chart was starting to break down. And it did exactly that. It broke down. It went to about a little bit further than that. It went to about $320. It was only there for a short time and then made a nice bounce. And several members in the Discord community were able to buy John Deere in that range. So it was a good buy. It's up about 6.5%, which is, a decent number for a dividend type stock like this, a blue chip type stock. But this is a 150 plus year old company that's really pivoting to try to reinvent themselves as more of a technology play. In fact, they just hired a chief technology officer, and I go into detail on that video, but they're getting into autonomous electric tractors. We're talking about autonomous drones, some really, really cool stuff in technology. It's kind of I call it the Tesla of agriculture, which is a stretch, but it really is reinventing itself. It's one that ARC ETFs have been buying as well. And at 24 PE ratio, it's at $351 right now. I honestly don't think it's expensive here and think it can go higher. It was a $400 stock, all-time high. I think it gets back to that range and probably even goes higher. Of course, if you can get it lower, even better. I always dollar cost average. But a 24 PE ratio, solid 1% dividend. Again, if you want more information on John Deere, I've got an entire video on the channel, so check that out. Now, this next one here, I've owned for a long time. I've made several videos talking about it. I did a DGIF series, the top 60 dividend growth investing stocks for the next decade. And on the technology one, Lam was in there, I think, at 3rd, and I said it could easily be number 1, but I had to be careful because of Apple and Nvidia and those. So I really like this stock. I have high conviction. This is really going to be a 2-for-1 because I'm going to talk about Lam Research and Nvidia. I've been long both for a long time. In fact, in Nvidia, if you watched the last top 5 stock video I did, Nvidia was on that trading around $500, $550 a share, and now it's $800 a share. Made a nice run. Now, Lam is not going to behave quite like an Nvidia, and it's not going to trade at the valuation of Nvidia, but this is a solid DGIF type stock. The dividend now is only 0.8%. PE is around 27, and it is somewhat expensive here because the all-time high was $673 and it's trading at $645. But I'm going to show you an article here in a second that will paint a picture of why I think this is still a good buy. And for a long-term investor, this is something still to hold for a long time. Now, I've been in Lam Research for several years. I'm lucky. I have a cost basis, and this includes dividend reinvested, so it was actually less than this, of $160 with dividends in there. And basically a $9,500 cost basis is worth about $40,000. So this is a pretty good holding in the portfolio, $160 cost basis on a $645 stock. Nvidia, kind of the same deal, was buying that around $135, $150. Now it's $800. Semiconductors, I call them the new oil. I've got a video series on the channel, on the Fired Up Wealth channel, that is exactly that. Semiconductors, the new oil. And I'm bullish on several names in this sector. Even the ETFs like SMH and SOX are a good play in this sector. But I'm going to show you an article that's going to talk about Lam. It's going to talk about Nvidia. It also talks about Applied Materials, but I'm going to focus on Lam Research. Stay tuned. Okay, so check this out. This is from Seeking Alpha, and the name's pushing AI towards a $1 trillion chip market. It talks about Applied Materials, talks about Nvidia as the undisputed leader, and I agree with that in the AI training roadmap. So listen to this, though. Okay, so it says, also observes that the slowdown of Moore's law, an industry rule of thumb, noting that transistors in a dense integrated circuit double about every 2 years, is a tailwind for semiconductor equipment companies like Applied Materials and Lam Research, LRCX, baby, as higher workloads call for advanced solutions, and the WFE market in 2030 could be $140 billion versus only about $60 billion today. And then this last part talks about basically how they see the semi-cap players like Applied Materials and Lam Research enabling foundries like Taiwan Semiconductor. I think Lam Research is a great long-term hold even from here. Of course, if you can get it cheaper, it's even better, but this is one that I want in my portfolio for 5 to 10 years. Okay, so this one I've covered several times. It's obviously a no-brainer at this point, in my opinion, but I think it's actually at a good spot here technically on a breakout. It was better, a week or two ago, of course, but I'm going to show you some technicals here in a second. I'll show you a chart of where I think Apple could go. But even at this price at $136, I would love it under 135, 125 to 130 was kind of the sweet spot. And it is a little bit expensive here, but I think it can go higher. It's a 30P ratio. Now, historically, Apple does trade at a lower multiple, but you have to remember too that the stock has really revalued itself higher because of the services part, which is more of a recurring model, right? So, 0.65% dividend, not a huge dividend, but when you think of Apple, you think of 5G super cycle, you think of their new computers and components. The company's strong. It has a strong following, a kind of a cult following. And yes, it's a, $2.275 trillion market cap. So this is not going to be a growth stock that's going to just dominate your portfolio by any means. But it is one that I like in this range. Let me show you some technicals. Okay, so if you're in Discord, you've seen this many times because we have chart day every Wednesday. We've covered this several times. And I've said multiple times that it's trading really in this wedge. You can see those yellow lines on your screen. It's trading in a wedge. And I said to the team that it was probably going to break out to the upside. And it's done exactly that. You can see it's broken out of this wedge and it's gone higher. Now, of course, it would have been much better to buy in this range. As I mentioned earlier, kind of 125 was the sweet spot. But I do think it has potential to go higher from here, probably all-time highs. I think it could go to 150, maybe even $170 by the end of the year. I know that's pretty aggressive, and I generally don't throw out aggressive numbers like that. But if the bull market continues and the market keeps running hot, I could seriously see this stock at $170 a share. Again, it's not a hyper growth stock or anything like that, but the company's probably not going anywhere for a long time. It's something that, I feel safe at night sleeping. Sleep well at night. They call them swan stocks. I can sleep well at night having Apple in my portfolio. I've had this stock for quite a while. I own about 361 shares. My cost basis is $33, so I'm up 300% on it. But that's how long-term investing works, especially as a dividend growth investor. You let those dividends compound. My purchase price says $33.75, but that's dividends included. So it's really much lower than that because I've had this stock for many years and it's, compounded. And I've actually sold some along the way. I've sold a few times and regretted it. I've shaved it. But at this point, I own about $50,000 of Apple stock. And I do like it in this price point. I like it better, 125. But I think that even in this range, it probably is going to go higher. And it's something that you can hold in your portfolio for the next, 5-10 years, as long as the story doesn't change. Especially with this 5G super cycle, I think over the next few years, you're going to see an acceleration in Apple's revenues and their profits. And they've got a lot of cash too. So I'm always curious to see what they're going to do with that cash. The problem is when you're this big, antitrust doesn't let you acquire a whole lot. But they have enough money to literally buy out every NFL team and have enough money to buy a couple islands, countries. And I'm not even joking. Their cash balance is absolutely insane. So Apple, I'm long Apple. This is one that I felt I had to include in the top 5. It's a little bit late to the party. If it pulls back a little bit, definitely, in my opinion, it's an ad. Okay, so number 5 is Activision. Now, for those who have been patient and are still watching, there's actually going to be 6 stocks on this video. And there's a bonus one that I've never talked about before that I'm going to cover next. So do stay tuned for that. It's a 32P ratio, so it's not dirt cheap by any means. It just kind of came off of this nice bottom kind of range here, close to $90. And it's starting to pop up higher. It was $104. It's at $95. I think it's an opportunity here. It probably goes and breaks this, $100 barrier and probably goes to all-time highs over the next, several months. So this isn't going to be a high growth stock by any means, but I think when you look at their business and especially with their mobile gaming and you think of Activision Blizzard with Warcraft, I've owned this stock before. I was disappointed with it. I ended up selling it a couple years ago. They had some growing pains, some struggles, some management struggles and things. So this one I'm the least confident on out of the 5 on this list so far. But there are a lot of people in the community that like this stock. It's 0.49% dividend yield. I think it has good long-term growth prospects. It's not going anywhere. And it's one that I think is attractive, under this $100 mark that I think can go higher. Let's take a look, though, at all the different games that Activision Blizzard owns. Okay, this is pretty recent, May 4th, their first quarter 2021 results. This is a nice little slide deck. And they had pretty good earnings. You look at, they've got, here's all the information here, and you can go through this. I don't want to spend a lot of time on it, but revenues were $2.28 billion versus an outlook of so they had beat on that. The net bookings was up quite a bit versus outlook. The earnings per share was a beat. So good earnings, solid earnings. This is another one like Logitech where you say, well, it's kind of part of the whole stay at home kind of trade where everybody was at home playing video games. Yeah, that's true. But the stock, has kind of consolidated in a range, and I think, is a decent price in this range. It's not dirt cheap, like I said, the price to earnings, but when you look at the growth prospects, I think it's a pretty fair price. It talks real quick here about executing against their 3 strategic pillars. They've got expand their audience reach, deepen engagement, increase player investment. But what I really wanted to show you here was all the different brands kind of underneath, the company. So Call of Duty, of course, is huge, and there's tons of different Call of Duty and mobile and all those. Blizzard, so you've got World of Warcraft, which I used to be really into at one point, Hearthstone, the Diablo series, Overwatch League. You've got King, you got Candy Crush. Here's the mobile side. I do like the mobile side of the business because you think now that the pandemic's over, the nice thing about this is it's balanced. So when people are at home, they're playing on PC, on console, on PlayStation, Xbox. Now that people are going back to work and school, they're going to be still playing games, but more on the mobile. They're, on a bus, on the subway, in a lift, whatever. That's where Activision Blizzard has some strength versus some of the competition, because you think like Take-Two, I own Take-Two and I'm long on it, and they've been trying to do more on the mobile side. But I think Activision's just set up a little bit better on the mobile gaming side. You think of Candy Crush is the big one that, and King, Farm Heroes, there's a bunch of them. But you can see, here's kind of the segment results. I think this gives you a good picture of the business overall. Activision, $891 million, Blizzard, $483 million, and King, $609 million. So it's got a nice balance, because really when I think of the Activision side, I really think mostly on the console. When I think of Blizzard, if you're playing World of Warcraft, you're playing on a PC probably, right? So you've got console, you've got the PC gamer, and you've got the mobile gamer. It's probably the most balanced when you think of, gaming stocks. Tencent is a monster too. When you think of, the US gaming stocks, when you think of like Take-Two, EA, Activision's Blizzard is probably the most balanced between these kind of 3 heads when you think of console, PC, and mobile. All right, so I'm going to bet you that you haven't heard of this company. You might have think you heard about it, but it's different than what you think it is. But you probably don't see much coverage on this one, especially on YouTube. It's a mid-cap. This is a bonus pick. Brunswick Corporation, 16.5 P ratio. It pays a 1.36% dividend yield. They just made this acquisition here of Navico, which is a Norwegian company. And there's a lot of analysts talking about it, which is why it got my attention. It says it's going to basically boost their global parts business. And then also here it says Wedbush says that the acquisition of Navico is complementary to parts and accessories business. What these guys do, this is not Brunswick pool tables. And I actually was confused myself because I'm like, well, Brunswick, I used to have a pool table and it was a Brunswick. This is a boating company. So they design, manufacture, and market recreational products worldwide. It operates, so they have propulsion, parts and accessories, and boat segments. There's also a financial group. So like they do loans, financing, and basically you can go on and on. But Mercury, so you think of Mercury Marine, Mercury, all these different Mercury brands. It's Mercury and Mercury Racing. So if you've seen a Mercury boat, it's Brunswick. And so this company, it's actually, based in Illinois. It was founded in 1845. So it's been around a long time. This isn't going to be one that's going to be a high growth stock or anything, but it has pulled back nicely. You can see that it's pulled back to $98.65. The high on it was $117.62. So I think it might be an opportunity, below this $100 mark. I think the short-term low was around $93 or something, it looks like on this chart. But I think under $100 presents an opportunity for more of a conservative value type play. This doesn't have a lot of volume. There's not a lot of people that know about this company. The volume is 110,000. So there's not a lot of excitement in this necessarily. But let me show you a little bit more about what the company does. Totally mixing it up on you. I got the camera over here, moving it around. Just really quick, innovation and inspiration. This talks about, so they've actually 14,382 employees. I was pretty surprised by that. Global operations 24, and they've of course just added more people with this recent acquisition. But you can see United States, Europe is a pretty small segment, although again, they just had this acquisition here. Canada is this green line, and then Asia Pacific. So they are a global company, but mostly in the United States. And if you look at the Brunswick advantage, great business, attractive markets, credible, profitable growth. They've got the propulsion, the parts and accessories, the boats, there's different segments, but essentially this is boating. And so you look at just from a high level, like what are my thoughts? Why do I think this stock has potential? It's a quality company. The balance sheet looked good. When I took a look at the balance sheet, the leadership, looks fine. The history, like I said, it's an older company that's been around. When you think of the pandemic, they definitely had a boost, in sales. Now, there's a CEO letter that I read on here, and it talks about how they had some issues with supply chain things. I think they're actually going to be more profitable coming on the other side of this as inflation and things kind of cool down. And I think it's one of these companies that more people are going to want to do things when they get out of the pandemic. So, people are probably buying boats right now. It's summertime, and I'm thinking that the next couple quarters might have good earnings. And I'm thinking over the next, couple of years, you might have some pull through where people just want to get out of the house. They want to experience things. Let's go buy a boat. So to me, I think there's opportunity here. Of course, this is a very niche type stock, and it's not going to be for everybody, which is why it's a bonus pick. But I wanted to bring it to your attention. I think it's attractive at a 16P ratio. And like I said, nice little dividend. It's a 16.5 P ratio, 1.36% dividend. So check out Brunswick. The ticker is BC. So there it is, my top 5, really top 6, I guess, if you count the bonus pick. Dividend growth investing stocks, dividend growth investing for F.I.R.E.D, DGIF stocks for the month of July. These are stocks that I think have decent value at their current price and something you can consider. As a reminder, I'm not a financial advisor. I can't tell you what to buy or sell. These are just ideas for you to explore. Please subscribe to the channel. If you want to help me, this is free content for you guys. In return, what you can really do to help me, if you want to help me out, hit the like button, drop me a comment. Even if it's a thanks, Eric, take you 2 seconds. It helps the algorithm. It helps me out more than you can imagine. And I appreciate your support. So there you got it. Subscribe. We've got more videos coming every Tuesday and Thursday at 9 p.m. Eastern, and I'm going to keep doing that as long as people keep watching the videos. So subscribe. Check out the channel if you're new to the channel. There's tons of videos. We're just getting started at Fired Up Wealth, but I appreciate your time and attention. I hope you have a great rest of your day. Take care.